Markets feel fast. Prices move instantly. News arrives before it has been understood. Performance is tracked daily, sometimes hourly, but capital compounds slowly. That is the tension most investors never resolve. The environment demands speed. The process that builds wealth requires time. Daniel Kahneman spent decades studying how we think. He identified two systems. One is fast, reactive, automatic. One is slow, deliberate, effortful. Markets are complexity environments. They reward the slow system. But they are experienced in ways that activate the fast one. The result is a hidden tax, not a fee on a statement, a behavioral cost, paid repeatedly by investors who act under urgency the situation never required. Urgency feels intelligent. It feels like diligence, like staying ahead. Patience feels inactive, like falling behind. Only one of them compounds. Urgency is not only psychological, it is structural. Brokerage platforms earn from transactions. The more capital moves, the more they earn. This is not conspiracy. It is a business model. Financial media earns from volatility. A stable, slowly rising market generates nothing worth covering. Volatility generates narratives, urgency, attention. Social platforms amplify the extreme. The patient take does not travel. The urgent warning does. The dramatic thesis spreads. The infrastructure surrounding investing is not neutral. It is built for motion. Warren Buffett observed it plainly. Markets transfer wealth from the impatient to the patient. The average holding period has collapsed over decades. Information moves faster. Emotional turnover accelerates alongside it. More participants making more decisions over shorter timeframes, which means the investor operating on a longer horizon competes against fewer people. Activity is visible. It looks like work. Patience is invisible. It looks like nothing. But invisible advantages compound quietly, and the compounding is real whether or not it can be seen. Here is an idea that rarely gets enough attention. The longer your time horizon, the fewer competitors you face. Most capital in public markets cannot wait. Institutional money is evaluated quarterly. Fund managers face redemption risk if performance lags. Pension obligations create liquidity requirements. Corporate treasuries operate under constraints unrelated to optimal holding periods. Individual investors face none of these pressures. In theory, a private investor with a long horizon operates where almost no professional capital can follow. The competition thins dramatically as the time frame extends. Patience creates lower decision frequency. Fewer decisions mean fewer opportunities for error. It creates lower tax drag. Deferred gains are an interest-free loan on your tax liability. Over decades, that is not a minor consideration. It creates compounding continuity. Uninterrupted growth is not the same as interrupted growth resumed. The curve behaves differently. Charlie Munger said it directly. The big money is not in the buying and the selling. It is in the waiting. Patience is not passivity. It is strategic non-interference. Compounding does not require brilliance. It requires non-disruption. None of this is comfortable. It is worth being honest about that. Patience is emotionally expensive. You look wrong before you look right. That is almost definitional. If a thesis requires time, the market will not confirm it immediately. The people who sold earlier will appear to have made the better decision. Living through that period is genuinely difficult. During bubbles, The patient investor underperforms, sometimes dramatically. The assets they avoided are rising. The risks they identified are not yet resolving. The narrative surrounding what they missed is growing louder, and the impatience that eventually ends the patience rarely feels like impatience. It feels like updated thinking, like rational response to new information, like risk management. This is one of the subtler dangers in behavioral finance. Impatience disguises itself as reason. Discomfort generates a search for justification, and the justification, once found, feels like a conclusion. True patience requires identity separation from short-term outcomes, the ability to observe underperformance without interpreting it as evidence of poor judgment, reduced ego attachment to what the portfolio does in any given quarter. Because the quarter is not the unit of measurement that matters. The greatest threat to compounding is not volatility, it is interference. And interference almost always arrives wearing the clothes of reason. Markets do not reward the fastest participant. Speed is an edge, only at timescales individual investors cannot access. For everyone else, speed is largely noise. Markets do not reward the loudest. Confidence and return are different currencies. They are often in tension. Markets do not reward the most certain. Certainty is frequently a psychological artifact, not an analytical one. What markets reward over long periods is durability. Solvency is the precondition for everything. An investor who survives a downturn with capital intact can participate in the recovery. An investor who does not survive cannot. Optionality is patience made structural, keeping capital available, maintaining flexibility, avoiding positions that cannot be exited without catastrophic loss. These are not signs of timidity. They are recognitions that the future will contain opportunities that cannot be anticipated now. Emotional stability is the substrate beneath all of it. The ability to observe volatility without reacting, to sit in ambiguity without requiring resolution, to allow a thesis the time it needs. That investor has a structural advantage, one that compounds alongside the capital. The market does not require you to act constantly. It requires you to survive consistently, and survival favors those who can wait.